The next chapter is Introduction to Strategic Management Performance. Here we have two main concepts. In short, strategy is the competitive position that a company will choose to achieve by variety of activities and a mix of values. And the next part is performance management. Here we are going to see how are we going to measure the performance against the goals. Now, when these both interlinks, that concept is called as strategic performance management. Strategy is the guiding force for establishing performance indicators and parameters. So through the strategy only, we will see how can we measure the performance. What parameters can we have to measure it? So it helps in performance management also. And this performance management, it also helps in ease of strategic planning. So both are interlinked here. Now let us see what is performance management. So when all the business activities and all the business processes are interlinked to create a value, that is what is called as performance integration. Now here, all the aspects of business should be aligned. So what are these aspects that should be aligned? We will divide all the aspects into four, which is first one is people, operations, strategy, and technology. All these have to be linked in order to have the business integrated. Now how can we do it? We can do it by our models, which are divided into two. There is Porter's value chain and there is McKinsey 7S model. We'll see one by one. First is Porter's value chain analysis. Here we will divide all the activities into two. First one being primary activities, and the second one is support activities. In primary activities, we have 5 activities. Two of them are logistics, one is inbound, second is outbound. And the second one is operations. Then we have marketing and sales as one. And finally, we have services. These are primary activities that are directly involved in the transformation of the products or provisioning of services. Here we have our infrastructure, human resource management, technology development, and procurement. So, primary activities are directly involved in transformation of products and provisioning of services. Then what does the support activities do? They will help in ensuring support to perform the primary activities. Let me explain each and every activity also. So, inbound logistics is basically receiving, storing, and handling raw materials for the inputs for the production. And outbound logistics will be storing and distribution and how do they deliver it to the final customers. And operations will be how are we going to transform the raw materials into finished goods. And marketing and sales, I hope you know this is doing market search. How are we going to have our marketing mix, the product, the 4 Ps, which we have discussed in chapter 1. And finally, we have services. This is after sale services. Finally, we have after sale services, which are like installation, any training, and repair, all these things. And then support activities, we have firm infrastructure. This is firm infrastructure. How is the firm organized? This will come under firm infrastructure. And second, we have human resource management. Here we will see how are people being a contribution in achieving the competitive advantage. And next thing we have is technology development. This is how the firm uses the technology. And finally, we have procurement. So this procurement is purchasing, but the inbound logistics only belongs to the raw materials. Here, this is not just the raw materials. This includes all other purchasing like asset purchasing. Well, let's see how do we do this value chain analysis. First thing, we have to find out the key value drivers for each of the activities. And once we have found out these drivers, then we will categorize all these activities into value added activities and non-value added activities. Now, when we are classifying these activities into non-value added activities or value added activities, this can be problematic because let's say one employee is working in HR management, and according to him, he works very well, okay, and according to him, it is also a value added activities because he is putting all his efforts into this activity. Now, once we figure out this, that HR management is not our value added activities, it is not adding any value to our company, and it is a non-value added to, it is an NVA to our company, it can become problematic. The employee will not agree to it. And we also cannot define how do we add value to the activities. So this classification can be difficult. That is why we have solution. We don't classify these into two value added and non-value added activities. We will classify it into 4 activities. First one, this cannot be improved, simplified, or reduced on basis of cost. On cost basis, there is no option to improve, or there is no option to simplify, or there is no option to reduce also. But it is required for production. Now, what can we do? We cannot do anything. We just have to continue it. And the second category is it can be improved, simplified, or reduced. Again, it is all based on cost. But this is also required to produce. Then there is an option, there is a scope for improvement, there is a scope for simplification. Then we have to modify the product, modify the activity to improve the same. And thirdly, we have this activities which can be eliminated, but not immediately, but eventually. And it is also not required to produce. So then eventually we will eliminate it. And finally, we have activities which can be eliminated in the short run itself, and it is not required to produce also. Then we should immediately eliminate it. How else can we obtain competitive advantage? First thing, we can outsource our activities. All the non-value added activities which cannot be eliminated has to be outsourced, because we might not be best at it, but someone else will be best at it. In that way, you can save the cost also, you can increase your quality also. And secondly, comparison. So when you compare your value chain activity with your competitors and with the industry, it will help you to analyze what is the gap and what can we fix it as benchmark. Finally, we have to bring in the customer perspective also. For at the each stage of production, let it be procurement or let it be production or let it be storing, at each stage you should assume that the next user is the customer. Next user is the direct customer. We should consider them. Then we will see, is it really worth it for the customer, or will they appreciate this process? Only then we will know how much value the customer is able to put it. This will help us analyze the value also. And finally, we have value system. So in this value chain, the next process is to extend our value system. We can extend it to our customers and to our suppliers also. That way our value system will be extended and the whole quality will be higher. And the next concept that we have is value chain analysis and performance management. So now we have seen what is value chain analysis. Now let us see how does it help in performance management. So once we have done our value chain analysis, we should go for business integration, where all the 4 aspects should be aligned. Once that is also done, we can measure our performance. But before going to performance management, let us see what is McKinsey 7 is also. So we have 7 elements in McKinsey 7 is. The center one being superordinate goals, and others are strategy, structure, symptoms, staff, style, and skills. We will explain each of these. Before that, let us see what is this McKinsey 7 is. So here we have all the interrelated factors in the constellation. So here there is no hierarchy like which is important, which comes first, which comes next. There is no such hierarchy, and all areas are equally important. If all areas are equally important, then why this superordinate goals is in the center? This is also called as shared values. Why is it in the center? Because it is central to all the elements. Otherwise also, if you see, all the elements are connected to each and everything. To style also it is connected because it is going behind the superordinate rules. There is no line. Otherwise, it is connected to all other elements also. Each of the elements are connected to all other elements. You can see it here. Likewise. So, even though shared values is given in the center, only for the significance that it is central to all the elements. Now let us see what are the 7S divided into. This 7S is divided into 2, hard S and soft S. Hard S will have 3 elements, which is strategy, structure, and system. All this belonging to the top management. The top management will decide the strategy, the top management will have the structure, and they will have the system also. So since it is all coming from the top management, it is easy for them to influence. It is easy for them to bring any changes also. But however, the name is called as hardest. And the second set is softest. Here we have rest of the 4 elements, that is style, staff, skills, and shared values. Now all these are difficult for the management only to make changes. We need employees cooperation also. Now let us see each of the elements. First one is strategy. Now this is the plan or method that is specific to the organization, that the organization will plan to attain competitive advantage. Now this should be clearly articulated, it should be long term oriented, and it should be well aligned with all other elements also. Now this well alignment should be there in all the elements. Now let us see the next. Next is structure. Structure is the formal framework. How are the things done? How is it divided? How is it grouped? How are the tasks formulated? And what is the pattern of interaction? Like, let's say you are an employee, you should talk to your manager. Your manager will talk to CEO. This is the structure of the interaction that between, and likewise the tasks also. CEO will give work to managers and managers will give works to employees. All this is called a structure. Now the structure should be well defined. Everyone should be aware of it. It should be well communicated. And there are different types of structure which I have described in the next page. We'll see later. And next thing we have is systems. Now the systems are how are the processes and what are the daily activities, how is it programmed. That is system. So systems mainly content of knowledge management, and there should be a seamless flow of information. So the system should be well defined and it should be efficient also. And next thing we have is style. Style are the informal rules. These are not formal. These are not documented anywhere. These are informal completely, and it includes the cultures, attitudes, and beliefs of the management also and the employees also. This style should be supported and integrated to the strategy. Next, we have staff. Staff are the intellectual capital. This is the most precious resource for any company, any organization. So the staff should be well balanced, it should be well satisfied, and it should be well trained and motivated also. Only then we can get the most out of this resource. And next we have skills. Skills is the core competency of the organization. And how do we identify it, and have we identified it? Are we taking the best use of it? This should be the skill, and the skill should be core, it should be important. And if any non-core skills are needed, then we should immediately outsource it. And finally we have shared values, which is also called as superordinate goals. Staff will be using their skills in a particular system, in a particular style, to bring in a particular structure and through a particular strategy. Why are they doing all this? Because they have their values, because their values are shared, because they have goals. So these goals help in guiding the beliefs of the people. Now that we have seen the 7S, let us see how can we use the 7S effectively. First, we will start with the shared values. This is the central element. And then let's go to the hard elements, which can be easily changed by the management. And next, let's go to the soft elements and check for any changes if that has to be made or if there is any place for improvements. And then finally, you review the changes from time to time. Now, 7S and performance management. How does it link? So, performance management is checking whether the 7S is properly aligned and whether the 7S are integrated to each other. Here, we will have gap analysis also, like what is the gap between what is expected and what is actual. And we will have change management also. How can we improve it? And finally, we will have improved performance. Next, there are three elements which influence the performance management. Those are, first one is structure. Now, majorly we have taken two structures, which is functional and which is divisional. Now, how will we get the data in the functional structure? We will get it at each functional level, but in divisional, we will get it in hierarchy way. So we have lower down hierarchy. There we will get all the data. Who will be analyzing it? Here, the upper level will be analyzing all the management and employees. Here, obviously, the top management will be doing for various other divisions. And how does the culture influence it? So there are mainly major types of culture we have taken here. One is predictable and reliable culture, and the second one is creative and innovative culture. So the first one is very formal, which is a formal behavior, which is tried and tested methods which are approved because of the previous experiences. Next, we have risk-taking approach, risk-taking behavior. Here we are open to new methods. That is how the performance is changing, and how do we measure it? That also changes depending on these two cultures. And finally, we have strategy. Here, what they're telling is the performance management techniques that we are using and the strategy of organization should be aligned. This is what we saw in the beginning also. Strategic performance management, both the performance management and the strategy should be aligned. While we are aligning it, we should also focus on non-qualitative aspects. They can be quality, they can be innovation, they can be the time taken. All they should be aligned. Now, we have strategic performance issues in complex business environments, complex business structure. So first of all, what is the complex business structure? So in complex business structure, we will have diluted control. The control is diluted in many places, and we have shared objectives. We might have two or three organizations coming together for a common objective, and we have pooled resources. Again, same thing. Two or three organizations coming together and using the resources together, and they can be connected virtually, and there can be diverse business environments. These are complex. We have few examples. So we have a complex business. These will have network organization, or these can be strategic alliances, or they can be joint ventures, or they can be franchising, or they can be just licensing, or multinational companies, or complex supply chains. All these are complex business structure examples. Now, why do they do this? To perform better. Now let us see what are the problems we have in each of the structure and what is the solution for it. So main problem that we have is establishing objectives. Let's say we have a joint venture. A and B comes together. Now A will have a separate objective and B will have a separate objective. To establish a common objective, we should go for goal congruence. Both of their goals should be aligned together to form a common goal. That is called as goal congruence. And both or two or more. I'm using both here as an example, but it can be two or more also. When two or more organizations come together, there can be different approaches and the attitudes will also be different. Here we should have a common and minimum program. And accountability. Who shall be held accountable? This should be clearly established and communicated and documented also to avoid any conflicts. And next, we will have a lack of trust. Here, who do we report to? Who is taking all the control? All this should be mutually decided, and whichever is compatible for both the organization should be chosen. And finally, we will have cultural conflicts. This will be more possible in multinational corporations. Here, we should have more liberal shared values. Now, let us see all these cases and how does performance changes in each of the cases. First one, we have a strategic alliance. Here, the independence of the organizations is retained. Two organizations just come together for a particular project or for a particular period of time. So, independence of the organizations is retained. That is a plus point. But we have a negative problem also, which is we measure the performance, which is common to both. And second case that we have is joint venture. Here again we have to separate entities, which is a plus point. But how is it difficult? In this case, it is difficult to hold someone accountable. Next, we have multinationals. Here, the advantages are we can have our own culture, we can have our own language, etc. And what will be the negative disadvantage? How do we measure the performance and how do we report it? All this will again change from each nation to nation. And next, we have complex supply chain. Let us first understand what is a complex supply chain. Here, all the network is connected to each other. Usually, we will have supplier which is connected to us, the company, and the company will be connected to the distributor. Here, in complex supply chain, we have the company. We will be connected to a lot of suppliers, and we will also be connected to a lot of distributors. This structure is complex and complicated, which is what is explained here. Here, the advantages that we have is the collaboration between all these stakeholders. And the disadvantage we will have is communication barriers. We will not be able to communicate to them freely because we might be able to lose this supplier also. And incompatible technology. Let's say the main reason we have so many suppliers is to fill in our just-in-time orders. Say when a customer orders for 100 quantity of a final product which will require 1000 quantity of raw materials. Once the order comes, the JIT will process it to and send it to supplier requesting for the raw material. Let's say if he has only 800, the technology should be strong in such a way the rest of the 200 should automatically go to supplier 2. This is the main reason we will have a lot of suppliers in this complex supply chain. Now, if the technology is not compatible, then the whole point is not met. And next we have virtual organizations. Here we don't have any physical presence or we have little physical presence. Here, collecting the data which is relevant to us and which is reliable to us will be a problem. Now let us see the next topic, which is behavioral aspects, each of the aspects, and how does it influence the performance. First thing we have is accounting and accountability. Only when we account the processes that is happening, only when we document the quantitative aspects, it will be easy for us to hold someone accountable. And it will be easy for us to measure the performance also. So there is two types of accounting here. The first one is hard, which is we will consider all the financial aspects and all the quantitative information only. And the next one is soft accounting. Here we will consider all the human inputs also, which can be qualitative. And the next one is control. According to this concept, only when we have control, the performance will automatically increase. So it is directly proportional to each other. Now in control, we have three types. First one is behavioral control. Here, whatever is decided, only that actions will take place. It includes all the actions, all the behaviors. Second one is personal and cultural control. Here, every job should have appropriate person. The person should be well trained for that job. In that way, the performance will also increase because of the control that is presented. And finally, we have reporting control. Here, we will ensure the outcome of all efforts is reported very fairly. There should not be any manipulation in the reporting. And how can we predict and prevent the corporate failure? First, let us understand what is corporate failure, and next we will see how can we predict it, and finally we will see how do we prevent it. Now, why does the corporate failure occur? One main reason could be they might fail to innovate or they might fail to adapt to a change. One good example is Nokia. They failed to adapt to the current situation. They failed to adapt to the growing technology. That is why they failed. The whole organization failed. And second can be too much hostile business environment. Now, hostile environment is a situation where the employees are not feeling comfortable. They are feeling uncomfortable or they are feeling unsafe. Let us say an organization keep on doing layoffs. There is no job security for the organization. The performance directly decreases because the employees are more worried about the job, having the job, like that. Or there can be discrimination or the environment will be a toxic. All these are hostile environment. And next we have too many changes or restructuring. If a company continuously does restructuring, there is no time to adapt to the process only. Only when we get time to adapt to the process, the performance will automatically increase. And finally, financial misappropriation. This is manipulating the accounts. When it occurs, automatically the company will fail. and there is a power tussle in management. Let us say there is a fight in the management for the highest position, for the control, for the authority, for the influence. When the managers are struggling for this power, there is a lot of tension, there is a lot of division, and there is a disruption of harmony also, which will again lead to performance failure, which finally leads to the corporate failure. And finally, the strategy only doesn't work. Everything is fine, but if the strategy is not proper, then obviously the company, corporate, will fail. Now that we know what is corporate failure, let's see how can we predict it. Here we have two methods to predict it. One is quantitative, which is through the numbers, and second is qualitative. We have methods using numbers also, we have methods using the logic also. First, let's see what is quantitative. Here we will use all the financial ratios and all the financial values, and we will have particular risk factors also to predict the possibility of corporate failure. And qualitative aspects, we will consider the director's report, we will consider the regulatory filing, are they doing their legal responsibilities properly. We will also consider the brand and its equity. Failure is Altman Z Score. This is very, very important. Now, Altman Z Score got very famous and very useful because it considers multiple factors at a single point of time. When we are using ratios, financial ratios especially, but it doesn't give a whole picture about the company. That is why we need to consider multiple factors at a single point of time, and Altman Z Score is able to do this. So here, the Altman Z Score combines 5 key ratios, and they are multiplied by a predefined coefficients. So this is the formula for Altman Z score. This you will have to memorize it, especially the coefficients. Z score is 1.2 x1, and x1 is working capital by total assets, and plus 1.4 x2. X2 is retained earnings by total assets again, and 3.3 x3, which is EBIT, earnings before interest and tax, by total assets again. And we have 0.6 x4, which is market value of equity shares divided by total liabilities. Here only we will have liabilities. All other places we have assets only. And finally, we have 1, which need not be multiplied also, sales by total assets. Now, when we are able to calculate the Z score by putting in all these values, we will get one number. This number can anywhere between these three ranges. It can be less than 1.81, which is, according to Altman, is under the zone of distress, which has a danger of getting bankrupt. And whichever is between 1.81 and 2.99 is in gray zone. We will need to do more investigation. Now we need to have more investigation to check whether it is safe or whether it will go to distress. And whichever is more than 2.99 is safe. It is financially sound. So how efficient is this Z score? 72% accurate. So first we have Beaver's univariate model. Univariate means one variable. So here each accounting ratio will be considered one at a time. That is why it is called as univariate model. And next we have Tafler and Tisha's model. Here we will again use Z score, but we will develop PAS, that is performance analysis scores, which will be discussed later, don't worry. And next we have Zeta model. This is also an improved version of Z score only. This is also given by Altman only. But here we will be using other comprehensive inputs. Nothing else is defined in your book, so you need not be worried. And again, we have seen a formula for Z score. This is mainly for manufacturing units. And this is a general formula also. Manufacturing units also. So Altman decided for private firms, for non-manufacturers, and for emerging markets, that formula might not give a true picture. So he has revised the Z-score formula for these. First, for the private firms, 0.717, but here it is 0.847, 3.1073, 0.42, and 0.998. And for non-manufacturers, we have another coefficient 6.56, 3.26, 6.72, and 1.05. And for emerging markets, we have 3.25. Here there is no coefficient, just remember it. And 6.56, 3.26, 6.72, and 1.05. Here, for private firms, we have a separate number. And for non-manufacturers and emerging markets, we have a separate number. Distress zone will be for 1.23, less than 1.23 in case of private firms, and less than 1.1 in case of emerging markets and non-manufacturers. Again, gray zone, which is need to be investigated. Here 1.23 to 2.9, here 1.1 plus 2, 2.6, and safe zone, which is 2.9, and same like normal, and here it is just 2.6. Now let us see what is performance analysis score. Here we will convert the Z score in percentile term. So here we have Z is equal to 3.2 plus 12.18 into x1. X1 here is profit before tax by current assets, and 2.5 x2. X2 is current asset by current liability, and minus 10.68 x3. X3 is current liabilities by total assets, and finally we have 0.029 into x4. X4 is no credit interval. Here you can easily remember by PBT by current assets. Current assets will come here again. Current assets by current liability. Current liability will come here again. Current liability by total assets. Now, if the Z score is negative, then there is potential bankruptcy. Next, we also have one more model, which is H model. This is also similar to PAS, and the score will be 0 to 100. But if the score is greater than 25, then it is in the warning area. Now that we have seen all the quantitative models, we will see what are the shortcomings, what are the limitations in this model. Here, since all these are numbers, financial numbers, it can be easily manipulated by the management. And it only focuses for short time period. And even though that we will identify whether there is a potential for bankruptcy, it does not give what is the root cause and what is the solution for the problem. And finally, it has predetermined weights. All the coefficients that we saw are predetermined. Now, how is it relevant? How is it reliable? That is all again doubtful. So that is why we also have qualitative models. The first one we have is Argenti's A score. There is a particular process which fails, which will provide which will follow a particular sequence which is very predictable, and this will turn all the defects into mistakes, and all these mistakes will then become symptoms of failure. This is the major concept behind A score, Argenti's A score. Now let us see how to calculate. So in Argenti's A score, we have three major concepts. First one is defects, and defects can be management defects, which are like faulty structure and the strategy is not working, all that. And we have accounting defects, which is lack of budgetary control. This is just an example. And the second concept that we have is mistakes, which are results of defects. If you don't have proper budgetary control, then there will be mistakes in cost accounting or any accounting. And next concept is symptom of failure. Now, these are very visible deteriorating ratios or creative accounting. Let us solve one problem here. What you have to remember is we have three groups that we saw here: defects, mistakes, and symptoms of failure. And we have predetermined number also. For group A, can maximum be 10. Group A, that is defects, can maximum be 10. If it is more than 10, then there is a possibility of failure. Then we have group B, which should be less than or equal to 15. If it is more, then it is a failure. And total is not just A plus B, which is A plus B plus C, symptoms of failure also. This is C, this is A, this is B, this is C. And the total A plus B plus C all together should be less than or equal to 25. Let's see what all comes under group A. Group A is defects which can be management defects or which can be accounting defects. And here we have few examples. You can read it out later. And group B, we have mistakes. This also you can read it later. And finally, we have group C, which is symptom of failure, which is financial analysis, non-financial science, creative accounting, that is misrepresentation, all this. So let us solve this problem to get to know how much you have understood. So these are three rules that we have to follow. And here we have defects. Defects, whichever is more than 10, it is definitely failure. This is failure. Let us just mark this. This is definitely failure. And mistakes can be maximum 15. So this is allowed, this is allowed, this is allowed, allowed, this is not allowed. 6 is also a failure. And finally, we have symptoms of trouble. Here, if you see 10 and 15, the total should be 25. So if at all anything is there in C, if it is more than 1, then it is definitely a failure. So this is fine, this is fine, this is not fine, this is not fine. All these two are failures. This is fine, this is fine. And then we have overall threshold also, which is 25. This is equal to 25, this is less than 25, this is more than 25, it's already a failure. So these 4 are failure. Let us check it. So this is healthy, yes, it is less than 25, and individually also it is not crossing the limits. This is also healthy, yes, and this is risky because we have something in symptoms of trouble, and overall is also more than the 25. This is also risky, even though we have 0 defects and 0 mistakes. Since we have symptoms of trouble, it is risky. And Finally, we have risky because this is more than 10, and here we have risky because this is more than 15. Pretty easy problem. Now let us see what are the shortcomings of qualitative methods also. Here, since all these are qualitative, we have to apply our judgment, and which can be subjective. It can change from one person to another also. And obtaining this non-financial information is again not easy. And how is it reliable? How is it relevant? These are all critical factors that we have to evaluate. And again, even this does not suggest any solution. Now that we know how to predict it, how can we prevent corporate failure? So from the first, we have to keep on investigating and identifying all the causes. And if needed, we should seek external advice also. And finally, the managers should accept that the existence of problem. They should not be keen on blaming who is to be held accountable. They should first accept, yes, we have a problem and we need to fix it. And next, we should bring in changes. We should make some actions, and we should either get out of the problem or modify it, change it. In any way, we have to get out of the problem. And then the management system should be effective. And finally, after doing the changes, all this should be checked regularly also. And for that, we have controls put in place to prevent any other further loss.